Okay, so now we've gone through continuation entry types on our lower time frames. What we're going to do now is get into a slight variation, but they're still considered continuation entry types and, with the trend. So let's get straight into it. So we're on Euro USD on the hourly time frame. Now this was a trade that I took, I believe it was last week, which ended in, a very good return. So let's get straight into it. So what we are basically looking for is still our order block, our most recent lower high, or in an uptrend, a higher low. In this example, we're looking at, a sell trade. So we have, just zooming in, we have a lower low which was formed with this move down. This is the move that broke this most recent lower low. So if I just mark it on so you can see it, that was the low that was broken with that move there. So break of structure, like that. So once we had that, we had a new lower high, which would be up here. But then what we know is we have order blocks that we can trade from and refine, which is exactly what we have here. Now we can refine that on a 15-minute time frame, but the concepts I want to go through is what happens after. So what we can see is we put in that new lower low with that move there. So we have our area of interest, our lower high, which we want to look for sells if price comes to trade in. But if price does one of these two things, so what we've seen is we had this lower low, price pulled back, and then it actually broke structure again with that move there. So you can see price, before coming into that lower high, we had a second break of structure from the most recent lower low, which is here. Okay, so one thing that I'm always saying and is really important is it's about how price breaks. So is price breaking in the form of seeking liquidity, or is it breaking with momentum, showing us that price doesn't necessarily need to come back up to this level, and we're breaking with momentum so we can see an entry lower down? Or is it liquidity seeking? So how we can determine if it's liquidity or momentum is simply by looking how it breaks. Okay, so in this example, what we can see is we've broken with wicks, zero momentum. So you can see, corrective candles, there's nothing behind it apart from breaking the low and then retracing, because we can see it's a corrective move. There's nothing being left behind. There's no real supply zone or valid order block, because although we did close below that low, you can see, as I've said, it's very corrective. It's a calm break, and we can see wicks. So that for me is just seeking liquidity from anyone who's looking at that as an area to get short from. It's breaking the low, and as we already know, the highs and lows always get manipulated, and they always get taken out by ever so slightly before price reverses. Now the reason for that is just seeking liquidity, and there's nothing much else to it apart from that. So what we can see is we had a corrective and a liquidity break. So that's what I call it. So a liquidity break of that low. And we still have this area up here that we really need to be looking at to look for shorts. Because we can see prior to this move coming back up, we had the seek of liquidity. And if we also want to be extra, what we can have on is this high. Now it's not perfect. We have one high and a second. So we do have equal highs to some degree. So, some may be looking to sell from here. So we have sell side liquidity from the low and buy side liquidity from the highs as well. Okay, so people who are looking at this as, trend, lower low, lower high, lower low, lower high, they're looking to sell from the most recent lower high. but we can see it's liquidity. We have this supply zone up here, an unmitigated order block up here, which price is likely going to need to mitigate, a close of positions from larger interests, and a stack of more orders at this area. Okay, so that's exactly what happened here, which is why price respected that area. Now bear in mind, we only come in by 10%, but we'll get into that on this move here in a minute. But you can see a mitigation of these orders. Price continued. We took liquidity from this low, and then we tapped into an unmitigated area. So this is one of my favorite entries or entry types, because it's playing liquidity, understanding liquidity and how we can use it in our favor, and get involved in these trades, which is what myself and the other community members did do last week. We got involved in this trade. I believe I banked 20 plus something, 25, whatever it was, on this move here to the lower low. Okay, so just to recap, this is still a continuation trade, and bear in mind that on lower time frames, as you've seen in part one, we would get involved in this trade by lower time frame breaks of structure, whether that's going to be a double or a single boss. It would be a double confluence, because we've been breaking structure. We had a break of structure, lower low, lower high, mitigation, continuation. We're seeing clear order flow. We left this supply zone unmitigated before, but everything else is pretty much mitigated and clear downtrend. So we took liquidity, tapped into that area, and then we continued to the new lower low. And as I was saying about lows and highs getting manipulated, what we can see here, we did push down further, breaking that low. Then we had NFP, I believe that was, wick down, and then we did reverse. But what I was saying a minute ago about price only coming into 10% of that area, that in some degree is not mitigated. I will still trade it, and we can still trade with price coming into just this area here. But what it basically means is we don't really need to void this area for a future date in price. So what does that mean? Well, if I look at this area, okay, look how price come in again. Say, what is that? So the 1st of July to, not even a week. So 5 days. 5 days later, that area is still respected, because they more than likely had orders or, still, in the market, which needed to be closed out, say at a better price, which is why price then, mitigated perfectly to the T, literally to the pip. And then we see a massive sell-off down, which also, broke structure. We can see that. So a quick rule of thumb for me is, if we're looking at an area, say an order block like this, the 50% mark of that supply or demand or order block level, the 50% mark, so the equilibrium, is the area which I classify something as mitigated. So meaning, if this move was to come into the 50%, so up here, then I would class that as, a completed transaction and a mitigation. So if price was to come back in here, as we have, I wouldn't really be looking for entries, because it's already been mitigated to, at least the 50%. But what we can see is price did not mitigate to the 50%. So we can, in this example, we can still look for entries once price comes into the 50%, as it did exactly here. Okay, so that is just going to be, a really key tip that we can look at. The 50% mark, that's what I've seen in my testing, and that's a really good area to be looking for, your mitigations and yeah, so that's what we got here. That is the only reason why price, sold off aggressively, is from that area there.